General Mills. So General Mills it's hard to have breakfast, let's say for a week, without eating a General Mills product. These guys were doing quite well coming out of COVID because food prices had really gone up. And I think General Mills was benefiting from the fact that inflation was hitting their revenue, meaning their revenue was getting bigger and representing itself as a bigger number. But since then, it's really come down. As I've mentioned before, I'm not looking to get into consumer staples. I think they underperform. I think they are kind of a recession hedge. Like if we get into recession, these things start looking good. But I'm not investing to be protected during recessions in stocks. I'm invested in bonds to do that, right? My bonds will get me through the next 5 years, and that's what they serve the purpose for. So my stocks, I want them to grow. I want rate of return, and that's why I stay away from consumer staples other than one stock, Kroger. These guys here have been around since 1866, which is a long time. But for the past year, not doing so well. You lost a little bit of money when you consider you got a dividend, but you lost your stock depreciated by 4.3%. Their cap is 35 billion, revenue 19.9 billion. PE looks really low. But let's take a look at their growth. So this is where we saw that inflation. The inflation kind of caused the growth in revenue. Now, that's kind of a tailwind, so to speak, because they're like, all right, cool, we get to charge more money. But now they're really like faced with no growth. It's like, where are they going to grow their company? And they're not growing. So I would say you got to multiply their free cash flow times 10 to get to a valuation based on the market cap. They're about $1 billion company times 10. It's a $10 billion market cap valuation company to me. And that's not even looking at the balance sheet. So this one here just is not something I would be investing in. Their margins are 36, 37. You know, the cash flow I think is not high enough. If you're a super like mature business, your cash should be higher. But they run big factories, and those factories need a lot of maintenance and repair, and that's where the capex is coming in, and probably taking a lot of cash away from the balance sheet. Looking at the balance sheet, debt 14.5, cash 2.29, debt to EBITDA 3.22. That's fine, right at the limit. So this one here is a pass for me. Under what conditions would this be a good idea? I don't know. It's just not an industry I like touching. I think Kroger's fine for me. Kroger's done great. I feel like I've got a little bit of exposure to the food industry, but I've got a stock that is one of the best players in the business, and I'm good with Kroger. Kroger's getting it done. And Kroger doesn't have to figure out what's the next cereal that's going to be the best cereal to put on the table for breakfast, because they get to sell whatever cereal is hot. They also get to, have a portfolio of products in their stores that, are going to sell. They can adjust. So this is my one stock as a consumer staple. It was a stock that I feel is just a really well-run company that's really valued well. Warren Buffett owns this stock, Kroger. So that's General Mills. I'll just tell you how I feel about it. Hopefully, and Kiter, I'm not completely opposite to how you feel about it, but what are your comments on it?
Yeah, I agree. Not much to add. As you said, it's a more like a hedge as recession resistance. It's also, as you showing on your screen, it's close to 52 weeks low, and for the short term, it's maybe go up. They are increasing their dividends. They are doing buybacks. That's what I like.
Mm-hmm.
And yeah, not much more than that. They are for the more stable part of the portfolio, with the hope that they will not drop. But their P is fine. The buyback is fine. The dividend is fine. So financially wise, I think they are okay. That's my opinion, not something that contradicts yours.
And yeah, like Warren Buffett has said, he'd rather pay a fair price for a great company than to get a great price on a fair company. He's looking for great company. Like it's either misunderstood, like, a stock that has really rebounded and just crushed it, right? Like Allstate or Progressive, right? They were really written off like 3 years ago because the insurance business was not looking good. Well, they came back with a vengeance. That was really cool. Well, this one here, let's think about. So you got General Mills and you got 2025, 2026. The economy, is it going to go into recession? I don't think it's going to go into recession. I could be wrong, but I think 2025 is expected that we're going to continue to grow. And I don't see anything, or I haven't heard anything, I haven't read anything that says we're going to go into recession in 2026. So without a recession looming, I think, okay, there's no plus there for General Mills. General Mills, the stock, is going to have to compete with high flyers. And this past Friday, holy smokes, right? We had stocks really jump up. The NASDAQ was up 1.77, S&P 1.26. So when we look at a General Mills, man, they're competing for investing dollars for inflows against some stocks. They're just crushing it, right? So just the environment had to change. What's going to cause their growth? What's going to help the company start growing? There is one tiny bit amount of growth there. That looks good. If they can grow like 3, 4, 5%, the stock's going to move. So I would say if you watch this, you may catch a very discounted stock that is going to be priced 40% higher over the next year or two. Then that might be interesting. And we'll leave it at that.